Oil is at $107 a barrel right now, and it feels like a signal. That's how it works. A price this high, moving this fast, carries its own argument. It looks like confirmation that something real is happening, that whoever bought energy 6 months ago was right, that getting in now still makes sense. The price feels like permission. Here's the problem. The 3 biggest oil trading desks on Wall Street, JP Morgan, Goldman Sachs, Morgan Stanley, are all forecasting Brent averaging somewhere between $56 and $65 for the full year. That's not a small gap. That's a 30 to 40% drop from where we are today, built into their base case. So either the banks are wrong and the market is right, or $107 is doing something that high prices often do. It's disguising the future while making people feel like they understand the present. That's the question worth answering before anyone puts money into oil right now. The price spike has a specific cause. The U.S.-Israeli conflict with Iran escalated into direct disruption of traffic through the Strait of Hormuz. About 20% of all seaborne oil moves through that strait. When it becomes uncertain, even partly, even temporarily, the entire global market reprices risk overnight. Traders don't wait for actual supply to disappear. They price in the possibility that it might. That's what you're seeing at $107. Not a structural shortage, a fear premium. The U.S. government moved immediately. The Biden-era SPR, Strategic Petroleum Reserve, is being drawn down again. 172 million barrels released into the market on an exchange basis. Companies borrow the oil now, return more later. This pushes real physical supply into a market that is already scared. It's a ceiling mechanism. It doesn't remove the fear, but it limits how high the price can climb on supply anxiety alone. Geopolitical shocks do this every time. They arrive fast, they move prices dramatically, and then, once the immediate disruption either resolves or gets absorbed into new supply routes, the price comes back to wherever the structural fundamentals actually put it. The question is, where do the fundamentals put it? The structural picture is a supply surplus, and it's been building for months. Non-OPEC production, the US, Brazil, Guyana, Canada, keeps adding barrels. Global demand is growing at roughly 850,000 barrels per day in 2026, driven mainly by China and India. That sounds like a lot until you put it next to the supply additions and the math tips towards surplus. The IEA and EIA both see supply outpacing demand by 2 million barrels per day or more through 2026 into 2027. OPEC Plus is holding back output, still keeping roughly 2 to 3 million barrels per day off the market through voluntary cuts. But here's what that number doesn't tell you. Member compliance is uneven, and it's been getting worse. Saudi Arabia can afford to hold the line. A lot of other members can't. They need the revenue. They push production. The coalition holds together publicly while quietly fraying underneath. This is the key tension banks are pricing. OPEC Plus has the power to support prices if it maintains discipline, but every cut costs its members money today in exchange for a price benefit that gets diluted every time a non-OPEC producer adds a new well. Think about that from their side for a moment. You're Venezuela, or Iraq, or even the UAE. Your government budget depends on oil revenue, your currency is pegged to dollars, your social spending runs on export income. How long do you hold the line on cuts when Guyana keeps adding supply and U.S. shale is sitting at $85 break-even profits? That's not a rhetorical question. It's what determines where oil actually goes once this geopolitical noise settles out. Even if OPEC Plus holds together better than expected, the U.S. shale industry functions as a structural cap on how high oil prices can go and for how long. The Permian Basin in Texas and New Mexico produces roughly 6 million barrels per day. Current break-even costs run $60 to $70 a barrel. At $107, Permian producers are making extraordinary margins. That money flows into drilling programs, equipment, permits, hiring. Output follows with a lag of 6 to 12 months. When output rises, prices fall back toward the range where shale economics are merely good rather than extraordinary. The rig count is low right now, 412 active oil rigs near a multi-year low. That's actually a lagging indicator of what happens when capital dries up at $50 oil. It tells you about 2024 decisions. It doesn't tell you about decisions being made today at $107. Add the political context. The current administration is pro-drilling in a way that is operationally meaningful. Faster permits, Alaska opened, EV subsidies rolling back, methane regulation loosening. These are not symbolic gestures. They reduce the cost and timeline for producers to bring new supply online. What this means practically: the U.S. shale industry is wired to respond to high prices by adding supply, which then corrects the high prices. It's a self-limiting mechanism. Oil sustained above $80 to $85 tends to produce its own antidote within a year. That's not a bearish prediction. It's just the architecture of how this market works. Here is something worth noticing. Berkshire Hathaway, now run by Greg Abel, holds large positions in Chevron and Occidental Petroleum. BlackRock owns hundreds of millions of shares in Exxon and Chevron. Elliott Management has taken positions in Phillips 66 and Suncor. None of these are bets on crude going to $120 and staying there. They're positions in companies, businesses with production costs, balance sheets, dividend policies, and cash flows. Chevron produces oil at a cost well below $50 per barrel on its best assets. It pays a dividend that doesn't depend on whether Brent is at $65 or $107. If prices rise, the upside is real. If prices fall back to base case, the company still generates cash and the investor still gets paid to wait. This is a different trade than buying an oil ETF or a crude futures position. It's worth being precise about why. When you own futures or a product that tracks crude directly, your return is entirely a function of where the price goes. A 35% drop from $107 to $70 costs you 35% of your position. When you own Chevron at a price that assumes $65 oil, a drop to $65 costs you close to nothing. That scenario was already in the price. The stock acts as a floor on your exposure rather than a leveraged bet on the spike. Have you thought about what you're actually buying when you put money into energy? The commodity or the business? They produce very different outcomes in a normalizing market. Here is how to think about what happens next. Not what will happen, what would have to be true for each outcome. Base case: Brent averages $60 to $65 in 2026. The Strait of Hormuz situation stabilizes over the next few months. OPEC Plus quietly loosens cuts as member compliance continues to slip. U.S. shale producers respond to elevated prices by increasing output, adding supply to a market that already runs a surplus. China and India keep demand growing, but not fast enough to absorb the extra barrels. The geopolitical premium fades, the structural arithmetic reasserts itself, and prices mean revert. This is what J.P. Morgan, Goldman, and Morgan Stanley are all essentially modeling. Multiple institutions arriving at similar conclusions from different methodologies is meaningful. Bull case: Brent above $80, possibly sustaining. This requires the Strait of Hormuz disruption to intensify or persist, OPEC Plus to show unexpected discipline, and U.S. shale capital expenditure to remain constrained despite high prices. It's possible. Wars don't follow schedules. But it requires several things to break in the same direction simultaneously and stay that way. Bear case: Brent at $45 to $50. A U.S. recession, which elevated rates have been building the conditions for, cuts demand faster than supply adjusts. Or Chinese demand decelerates more sharply than current projections. Or EV adoption in emerging markets surprises to the upside. Any of these, or some combination, pushes the surplus deeper and prices lower than the base case. What strikes me about this range is where the probability mass sits. The base case and the bear case together cover most of the realistic outcome space. The bull case requires sustained supply disruption, historically the most temporary of all price drivers. Which scenario do you think is more likely right now? The base case where banks are roughly right, or the bull case where the geopolitical premium holds? It's worth having a real answer to that before making any position decision. At $107 oil, here is the practical logic. Direct exposure to crude, futures, ETFs tracking spot prices, leveraged energy products, carries the full weight of a potential 30 to 40% correction if the base case plays out. That's the downside in the scenario that three major institutions currently view as most likely. The better structure, if you want energy exposure at all, is in low-cost producers with strong balance sheets. Chevron, Exxon, EOG. They pay you to hold them through the uncertainty. They benefit if prices stay elevated, and they survive at $55 oil without drama. Keep position sizes modest. Watch OPEC Plus production decisions. Watch Middle East developments closely. They're the only real variable that can delay the mean reversion. The price you see on a commodity is always a mixture of what is real and what is feared. The skill is learning to tell them apart before you act. This video is for educational purposes only and does not constitute financial advice. Every investment carries risk, and you are responsible for your own research and decisions. Nothing here should be treated as a recommendation to buy or sell any security or commodity.